Well, thank you, David. Thanks everybody for having me here. Very excited. First time here, but already impressed. So hopefully I will be back for several more of these sessions and conference in the future. If you don't know me, I'm Hoda Mehr, founder and CEO of StockCard. I will tell you a little bit more about me in a short while, but today I wanted to do something a little bit different. I think you've been hearing about hardcore technical skills in terms of investing and trading. So I thought we would do a change of pace and talk about a little of a story and ask a question that is actually, I believe it's critical and important to answer. So I'm using Cathie Wood's example in asking ourselves, is she an investing genius or just lucky? Because this is a question a lot of us in the market have been asking ourselves, and we've seen a lot of that going on in the market. But the goal here really is not just to double down on Cathie Wood, although she is the talk of the town, or she's been the talk of the town for a long time. And if you don't know who Cathie Wood is, I will tell you about her and why it matters to talk about whether she's lucky or she's an investing genius. But really, the goal here for me is to share with you an investment as a framework to evaluate any investor. And why that matters, because we live in the age of celebrity investors. Well, of course, Cathie Wood is a fund manager. She manages several ETFs, but we are living in this age that a lot of people that we listen to or watch or collect our information from YouTube and Twitter and elsewhere are basically celebrity investors. So, and a lot of them are really, really good. And some of them are not that good. So the purpose of this presentation is to how we create a framework to evaluate whether an investor, a celebrity investor, is truly a genius investing, or actually a good investor, an intelligent trader, or just got lucky for a period of time, or just got very famous for some reason and ranked really high on YouTube or Twitter, and that's why everybody is listening it. So my goal today is just answer this question for you and for myself. It's something that I've been very curious about it, and let's just dive into what that framework could be. How do we evaluate an investor or a trader that we come across, whether they're a fund manager or a Twitter personality or YouTube or TikToker, to make sure they're actually worth our time and our attention? If that sounds like a good question, let's just make a quick introduction to who I am so that you know why I'm here and why I'm talking. So as I said, I'm Hoda. I'm founder and CEO of StockCard. StockCard.io is a company I created after a few years of managing a Facebook community of more than 30,000 people and talking stock in that Facebook community. In that community, I realized there is a need for simplified and easy to understand investment research and verified portfolio following, whether it's a Twitter personality or a YouTube personality that is sharing their content with you. So with the community on Facebook, so I quit my day job and then I started StockCard.io. And right after I started the company, I participated in the NASDAQ Entrepreneurship Milestone Maker program, and I was able to finish that program and was one of the milestone makers of the program. And that's me on the NASDAQ billboard in New York, which was really good to be there. I write a weekly newsletter for our users, more than 45,000 people to receive it. And I share my actual real money portfolio on StockCard, along with several other people who share their portfolio on the platform. And I've been, on average, outperforming the S&P 500 by 40%. And my background is on an MBA, and I'm an economist by training, and worked in technology sector for several years before I quit my job and started the company. So that's a little bit about me so that you know who I am and why I'm actually curious about this question. Now let's switch to Cathie Wood, because we put her on the pedestal today, and ask ourselves whether she's a genius, investing genius, or whether she is just lucky. So many of you may know her, but I want to tell you a little bit more about her rise to fame as a celebrity investor, and then maybe her fall from the fame. So she is the founder and CEO and CIO of ARK Invest, which manages several ETFs, and they focus on innovation. You most likely know her because you're here in this community talking about investing and trading. The chart here that you see is the number of Google search terms of the name Cathie Wood from 2014 up to yesterday. And as you see, she basically raised to status of a celebrity investor, that hockey stick you see sort of in the middle of 2020, right after coronavirus hit. And she was a celebrity for a while. Everybody loved her. And then now she is basically going down. Nobody cares that much anymore. And that's why, for a while, she was being considered as a genius, right? She's maybe one of the most well-known women investor, female investors in the world. And a lot of people started, as I said, appreciate her and, you know, put her on pedestal and follow her. And I sort of like, this chart you see here is the performance of her flagship ETF, RKK fund. It's his performance, and as you see, sort of, if I go back to my previous chart, it's almost identical. So as the fund was growing in terms of return, the love for Cathie Wood was just going up. She was growing in popularity, and then as the fund started to lose money, the love turned into hate, and she's losing her celebrity status. And people are actually starting asking themselves whether she's actually a genius or not. At the beginning of the coronavirus, when she was just going up and her performance was getting better, people created t-shirts in Cathie We Trust, Uncle, Auntie Cathie, Mama Cathie on Reddit. It's hilarious. You see how they compared her to big investors in the world. Warren Buffett, female version of Warren Buffett, all that good stuff. And then now the fund is going down a little bit from its high, and then now she's a problem. And there's urgent warning about her. So that's sort of like love and hate that is happening in the market. And maybe then one of the sort of worst hate I've seen out there, or I guess not liking her out there I've seen, is by Jim Cramer, that basically said, and if you don't know Jim Cramer, he's a TV personality talking about obviously stocks. I believe everybody knows him already. And he was a fund manager before he became a TV personality. And he basically says she invests like newbie. So that is the opposite of a genius investor title, or in Cathie We Trust that we've seen for a while the fund was going up. So that makes you wonder, what is Cathie truly that genius or not? And I've even seen other people in the industry, like Financial Times is a good example. There was an article on Financial Times asking the same question: is she lucky or is she a genius? And even they went to the extent of comparing Cathie Wood to some other fund managers in the history of the stock market who were known as people with golden touch, that basically after a small period of time that their fund went up, maybe the tech bubble burst in 2020, like 2000, the decade, 1919 and 2000. And a lot of these guys who were really have the golden touch lost tons of money for their investors, and at some point they stopped even investing and managing their fund. So this was the trigger for me last week, or I guess 2 weeks ago, when I saw that they started comparing Cathie Wood with someone like Garrett Van Wagoner, who was the ETF manager for the Emerging Growth Fund. And he's one of those guys that basically ranked high between 1996 and 2000. He was being compared to Peter Lynch as that kind of investor. And his fund gained almost 300% just before the tech bubble burst. He had about $101.5 billion in fund management, and then in asset under management, and then he lost it. When the tech bubble burst, he lost all of that money, and from $1.5 billion in asset under management, he went down to almost $100 million in asset under management. Later on, he changed the name of the fund, as of 2008, he was not involved in managing the fund at all. And then at some point, they basically just sold the portfolio of that fund. So people are starting saying Cathie Wood is the same as someone like Garrett Van Wagoner. And he was the golden boy, or he had the golden touch, and he lost the golden touch. And now people are saying Cathie Wood had the golden touch, and now she lost the golden touch. So that becomes the question: golden touch or not, a genius investor or not. But why does it really matter to answer that question, and why are we going to spend time today a little bit to talk about that and come up with that framework that we talked about? Is that what if the reason for that conversation is, what if you invested in Cathie Wood's fund on the top, and then now you're wondering whether you should hold and sell? Because if she is like Garrett, who Financial Times is comparing her to, you're probably better off cutting your losses because she would never recover. I don't know that, but that's what we're going to figure out today. Is she a cautionary tale and a disaster that could have been avoided had we had a good framework to evaluate Cathie Wood, learning from the history of the stock market of people known as golden boys and golden touch, people with golden touches? Maybe we would have not invested in it, and maybe we want to prevent that in the future. Again, I don't know the answer. We're going to figure out together today, but that's why we're asking this question. Another question we should ask ourselves and we should answer today is, if she's truly a good investor and she's a genius investor, and not just the ones that have like a tiny period of luck and then gonna lose all of it, maybe it's the time to buy. So the question is, should we buy now or not? I don't know, but we should answer that question today. And then, generally speaking, how do we distinguish luck from good investing? So the reason we are here is to come to answer these questions for ourselves and to be able to come up with that framework to help us evaluate Cathie Wood or any other celebrity investor and answer these questions here. I see there's a question here in the chat box. David, do you want me to pause, answer questions maybe here? If there's a question, how do you want to take questions before I proceed?
Let's see. I think there's just a couple of comments, but not any questions yet.
Okay.
But
right.
Yeah, whichever you want to do. If there any questions come through, if you want to answer them right away, or
sure, I can pause for a second and see.
Are you able to?
John is saying she's a still hot mama. Yeah, she's still. A lot of people believe Cathie Wood is still really, really good as investor, but also, as you saw in Financial Times, a lot of people are also comparing her with people who lost their touch, basically. I actually recently, in the Facebook group community that I was telling you that I still run it, although now we're basically a stock card. I posted something about what is all this hate to Cathie Wood, and then we had like 65 comments or 100 comments about Cathie Wood, and it was really, really half and half, 50-50. 50% were all for her and she's supporting her, and 50% were talking about she's a fraud, she invests in fraudulent companies. There's all sort of, she invests like newbie, like Kramer. So there's all sort of, the jury is out, some people are for her, and there's really a good love and hate relationship going on. If you hear sneezing, that's my dog sneezing under my desk. There we go. All right, so if there's no other question, feel free to pause to ask questions as we go. But if there's no other question, let's jump into the framework. All right, here we go. So a framework to evaluate an investor. I've spent so much time online trying to figure out how we can evaluate investors out there. None of us can predict the future. So what's available to us is the historical track record, the investment process an investor follows, and maybe using our own logic to sanity check the decisions that investor makes. As I said, we don't have the power of forecasting the future or seeing the future. So all we have to at our disposal in order to evaluate an investor is what they've done, what processes they use, and use our own logic to sanity check their decision. And I want to go through the example of evaluating Cathie Wood's a track record in managing different boom and bust of the cycle, and see whether is she truly capable of going through this up and down, or it was just one luck period of time and that's all there is to her. I want to evaluate her investment process and maybe compare to some of those golden touch investors like Garrett that we talked about. And I'm zooming in on Garrett, but there's a lot of other fund managers we could come up as an example to compare with Cathie, who had really good track records and then they lost it. But I just had more information about Garrett and I would use that as an example. And then I want to show you a quick valuation exercise, trying to figure out what she says actually has sanity and what she says has actually logic to it. And I hope you could use this framework or a similar framework to evaluate any YouTuber and TikToker or Twitter personality or fund manager, for that matter, that you would follow, and at least make sure that you're following the right people who you believe in based on logic. So let's go through this example together. Track record of handling a market cycle for Cathie Wood. That's the first part of the framework. So I went and looked at Cathie Wood's appearances on CNBC since 2014. She started ARK Invest in 2014, so she's been showing up on CNBC about that year. So I went through hundreds and hundreds of her presence and her appearances on CNBC as one example. Of course, she had a long career as a fund manager at Alliance Bernstein, or before that in different other companies. I don't talk about that, but I'm just only talking about what she's done since she started her company. There are hundreds of examples that there were a boom and then there was a bust. And I wanted to see whether Cathie was showing the same conviction that she's showing right now, even after the fact that her fund is down 60% from top of its all-time high. So here's two examples I found. In 2015, September of 2015, if you remember, Apple was going through this period of slowdown in devices, iPhone devices sales, and everybody basically said the late Steve Jobs is out, there's no good manager or leader there, they lost their dominance in the device market, seeing the devices are going down, the sales of the iPhone devices going down. And basically at the time, people were saying Apple is the new IBM, right? IBM not ever being able to recover from its glory, sort of fall from glory. But you would be surprised that Cathie, with the same passion that she has right now, that she defends examples of Teladoc and Zoom and Tesla, regardless of where they are and where their stocks is gone. She was very bullish on Apple's stock, and Apple's stock at the time was $115 per share back then. Actually, this is even pre-split. If you do it with the split, probably Apple's stock was about like $24, $25. So she went against, back then, she also went against the convection, the dominant sentiment in the market and defended Apple. Another example was in February 2016. And this was the time, I think I have a slide here. So this is 2019. This was the time that in the first 40 days of the year, ARK Invest was down almost 30%. NASDAQ, as a proxy for technology sector, was down almost 15%. And in her interviews in CNBC and the content that she was publishing back then as well, although everybody on CNBC or other media were calling the tech bubble burst, Cathie was talking about again how every time there's a period of uncertainty, people would use technology to get out of that uncertainty. Technology would solve problems during the periods of uncertainty. And I put the chart right after the interview she did on CNBC after that tech bubble burst warning by media. And so forget about this part, but like think about this period of time in 2016 all the way to where her fund is right now, is almost 300% gain. So I'm using these two examples as a way to talk about how Cathie has a track record of dealing with markets boom and bust. And this is not the first time she's going against the conventional wisdom. In the media, in the market, she has a track record of dealing with these sort of ups and downs of the market. So that's one thing. In a short period of time, I went through hundreds of examples for you. I shared with you two, and it looks like she does have a good track record of handling market cycles. The second thing I want to talk to you about is in that framework is evaluating the investment process, which is super important. Again, we can't predict the future, but we can look at the investment process that an investor follows and shares with people and see whether that investment process is solid or not. And that could tell us whether what she or he is saying is based on reality and based on some logic. So I want to bring back our friend, Garrett. He did some, as we talked about, he did have a similar pattern as Cathie Wood, 300% gain, tech bubble burst, and then he lost all of the money, and he lost all of the money out of his fund, moved out. And then at some point in the decade followed that tech bubble burst, he basically gave up even managing the fund. And any investor who invested in his fund, especially in the top, basically lost most of their money. But PBS had a documentary in 1997 that featured Garrett. And it was very interesting to understand his investment process from that documentary, because he talked about how he make investment decisions. And a few things came out of that study. So I did, obviously he's not like Cathie Wood, or I couldn't find any sort of like papers or PDFs or presentations by him that talks about his investment process. But from that documentary from PBS, it's actually available on YouTube if you ever search for it. I learned about his investment process. So he was a sentiment trader. Basically, he would try to predict the sentiment of the market and would do day trading. And he was investing in tech and healthcare stock, not too different from Cathie Wood, but he would invest in companies without any track record. As a matter of fact, a lot of his investments were in pre-IPO companies through his mutual fund, and then he would hold onto these companies during the IPO and for the period of the IPO. Like you have a lockup period after the IPO if you were a private investor, and then he would try to sell them or offload them as fast as he can once the lockup period is over, when the market has started evaluating that IPO. Something that was very interesting to me to learn about his investment process was he was himself surprised of his holdings upward movement. So he had I'm paraphrasing from a quote from that PBS documentary, that one of the holdings he had in his fund was up 30% one day, and he's like looked into camera and he said with a chuckle, X so and so just went up 30%. What did they do? Did they find gold today? And he was like chuckling around it. So it basically, the impression it gave me about his investment process is that he basically didn't have much of an investment process, because you can be a trader and you can try to predict or follow or find and understand the sentiment patterns. But when you make a comment like, oh, did these guys find a gold? It just tells me he's not making decisions even based on charts and patterns. He's basically trying to predict the sentiment. And one thing that was very interesting, this guy managed several ETFs, several mutual funds. Back then, mutual funds were a lot more dominant than ETFs. And he had an office out of San Francisco, and he was a one-man show. Based on an article I found on MarketWatch. So imagine if you're managing your own portfolio, and think about the last time you were trying to decide for trading or for long-term investing, fundamentally or technically, how long it took you to make an investment decision, how long it took you to look at the charts or read the fundamental data and evaluate whether to buy and sell that one stock. Now multiply that by hundreds and hundreds of holdings and multiply that by multiple mutual funds. And think about how hard would that be for one man show to manage these mutual funds. And that should tell you something about the process of that investor. I see there's a question. I'll get to you right after this. In contrast, Cathie Wood's ARK Invest process. They do significant amount of research. If you ever had a pleasure of going to YouTube and searching and watching the 5-hour big idea 2022 research that Cathie and her team and ARK Invest publishes, and listen to the depths of information, depths of research that they've done to support their investment ideas and investment picks, you'll be mind blown. So just the fact that she spends so much time on understanding what is happening in the industry should tell you about the due diligence that goes into investment decisions. She could be wrong, and they could be wrong, but at least there's a reliable process that anyone can read and follow and understand why they're making those decisions. And she also focuses on not companies without track record. She focuses on solid, innovative companies with sales and free cash flow generation power, a track record. And I have some data to share with you in a second. She also has a solid team. I put team as a part of process because as a founder, as an entrepreneur myself, and if you ever started a company or worked on a very difficult project, you know how difficult it is to do these things as a one-man show. A good team, a good solid team who support your decision-making, your research, and help you implement what you're trying to implement makes a difference for the success of that project or that company or that investment decision. So we're going to go through a few of that a little bit in a second, but I'm using these 3 data points to compare Cathie with Garrett to say how solid her process is, and maybe his process, as far as we know, was not as solid. So if you ever, in terms of the deep research, I think I highly, highly recommend you guys look up the big idea research on YouTube on our ARK Invest website to see what I'm talking about in terms of the depth of research. I do talk about solid, innovating companies, and a lot of people actually don't agree with me. A lot of people believe that Cathie invests in companies that have no track record. They're all just based on basically hype in terms of their opportunity, in terms of their growth. This is 2 charts that I want to share with you that I would use to counter argue that argument. So this is the top 5 holding revenue and free cash flow of the top 5 holding of RKK, which is the flagship fund, ETF fund of ARK Invest. So we have Tesla, Teladoc, Roku, Zoom, and Coinbase. And just I say those names, I know a lot of people in the audience are cringing because they believe these companies are not worth. They're not companies with solid track record. But in reality, if you look at the revenue, this is as of yesterday, trailing 12 months revenue and trailing 12 months free cash flow, actually last quarter free cash flow. You see all of these companies are generating in $1 billion of revenue, and they've been growing. Some of them have been growing rapidly. This big one up here is Tesla, but if you even look at Coinbase or Zoom, that a lot of people actually hate these days, Roku and Teladoc, even Teladoc that a lot of people don't believe in anymore, generates more than $2 billion in annual revenue in trading 12 months. And we also can say, okay, revenue is just revenue, it's sales, but what is a company without a profit? Most of these companies are not profitable. Almost all of them are not profitable. I guess Tesla is profitable, or depending on the quarter. But what I want to bring your attention is to free cash flow. So profitability may not be a right metric for a lot of these growth-driven stocks, but can their operations generate money? How do you evaluate that? Is free cash flow, right? So I pulled the free cash flow track record of the same top 5 holdings of ARKK. And as you see, all of them are free cash flow generating, positive free cash flow generating companies. Some of them are smaller, some of them are much bigger, but nevertheless, they've all found a way to pay for all of their company's operating expenses, and at the end of the day, there's still money left in the bank. So I'm using these two metric to talk about, to kind of make the argument that Cathie actually doesn't only invest in companies without any track record, or as they call it these days, a story stocks. It's very common these days. They say Cathie is only investing in story stocks, but in reality, when you look at the top holdings of the fund, a lot of them do have great track record. I'll talk to you about the team, and then I take that comment or question right after. So as I said, as a founder, I truly believe the team matters. Garrett, who was the golden boy or golden touch, a fund manager before the tech bubble burst in 2000, he was a one-man show. This is only ARK Invest analyst research team, so it doesn't have the associates, like associate analysts, and it doesn't have like portfolio managers or traders. This is just the 10 people who do the research on behalf of Cathie and the company in different technology and innovation platforms, as they call it, and support the decision making that goes through the fund. So we looked at the process. They do deep research. We looked at the track record of some of the companies that they invest in, and we looked at the team, and they're all solid company. And when you compare it to Garrett, who is our comparison case here, he had none of those criteria, but in his investment process. Let me pause here and take those chats and comments, and then we'll move right after to the last part of the framework today. All right, so let's see, what can we hear? Who is the sentiment trader again? So the name of the sentiment trader that I'm using as an example is Garrett. This guy, he was, let me go up here. Actually, let's go up here. So Garrett Van Wagoner, and he was the mutual fund manager behind Emerging Growth Fund. And he was one of those guys that was compared to Peter Lynch. And as an example that he had a golden touch before the tech and technology bubble burst. And he had similar pattern as Cathie Wood, but after the burst of the tech bubble burst in 2000, he was never able to recover. So that's why I'm using him as a comparison. BJ is asking, has the market been paying too much for these growth companies? This is a big question. Yes, so good question. That's why I'm coming back to the last part of the framework, which is the sanity checking of the decision making as it relates to valuation. So we'll get to your question, BJ, in a second. David is asking, like with any performance activity, athlete, trader, investor is difficult. Ultimately, as a trader, I have come to find out that the consistency is difficult, but it's key. Like with the sports, when you're winning, everybody loves you. When you're losing, nobody shows up. I agree, the team is key. So thank you so much. Yes, I agree with you totally. Valerie, thanks Hoda. I know that name, but not the face, so thank you. And then that's why I don't swing trade. I like good night's sleep, John is saying. So yes, so John is basically saying that he doesn't invest like Garrett and day trade because it's difficult. Although I have to say personally, I am a fundamental investor. I don't do day trading. I can't read patterns, but I don't say it's not the valid way of investing, right? It's the good way of investing. The question is, even if you're trading, are you following a consistent process that makes sense? And do you spend enough time on your process in order to make decisions, or is it just being gut-based decision-making, trying to predict what's happening in the market and in the sentiment? So we're not bashing Garrett or any other fund manager for that matter who's focusing on day trading or trying to predict the sentiment. It could be a very solid investment process approach, but we're questioning his process and whether he was actually using the right process. Now I want to get to the sanity check of the decision. I believe John or BJ or one of the questions we just talked about it was asking, well, maybe the problem with her is that she's paying for these crazy stocks, even though they have good track record at very crazy valuations, and that's the problem. And you're not alone in saying that. Several people basically question her sanity in making investment decision as it relates to valuation, and she's willing to pay any price for these stocks regardless of their track record. As I actually took a quote from the Financial Times article that I told you at the beginning of the presentation. It's from Lisa Michelet. She's a chief investment officer at Morgan Stanley Wealth Management, and she was former boss of Cathie Wood when both were at AllianceBernstein. And she said Cathie is a boom and bust investor because she doesn't disinvest or risk manage, right? So a lot of people are asking, why doesn't she stop the bleeding? If the fund is bleeding, why should she not cut the losses? Where is the stop losses, right? Why didn't she have basically a floor for her trades or her investments, and then at least prevent it from the bleeding, 60% bleeding from the high, and why she didn't take some of the profit off the table? And that's a very valid question, because in the world of finance management, actually finance and investing, managing your risk in managing the downside is as important as making good investment decisions and upward. So that's what we want to sanity check. Why, with a quick valuation exercise, why Cathie doesn't sell those top holdings or any of the holdings in her company, in her funds. What does she believe in that she keeps buying them, as a matter of fact, right? And let me switch from this presentation to a Google Sheet. I did a very quick valuation methodology for your valuation exercise for you, and maybe I make it a little bit bigger. I hope you see this and this is zoomed enough, because I want to try to figure out what is the growth potential of the companies. I'm going back to the top 5 holdings of the flagship RKK ETF. So I'm trying to predict where these stocks going to be in the next 5 years in terms of valuation that justifies why Cathie is not selling them and justifies why she keeps buying them on the top and even on the low, which is right now. So bear with me. It's a little bit mathematical. I think you guys be very familiar with it. I try to make it as simple as possible. But what I did is I took Tesla, Teladoc, Roku, Zoom, and Coin, their current market cap. The numbers are as of last night. I updated them last night, so I don't know what happened in the market since the market opened. So things have changed, might have changed, but this is the market cap as of last night. And this is the current price to sales ratio. So for the valuation, we're using the price to sales ratio to try to predict where these companies are going to end up at. So I wanted to first figure out what is these companies, what kind of a price to sales ratio we could expect from these companies in the next 5 years, right? So I brought a few different price to sales ratio for each of these companies. This column gives you the 5-year high price to sales ratio of these stocks, right? So the high, like for example, for Zoom, at the highest level, the price to sales ratio was something around 111, almost 112, right? That's one data point. I brought the 5-year low price to sales ratio for these companies. A lot of these companies are actually currently at their lowest price to sales ratio, as the lowest current valuation in the past 5 years. So that's another second data point. I brought the average price to sales ratio of software and application industry, and I brought the average price to sales ratio of the overall market. And then I calculated median of these data points, right? So we don't want to just like accept the current price to sales ratio. We also don't want to say these guys in 5 years going to go back as crazy as they were maybe back in June of last year. So we're not saying Zoom ever going to get 211 times price to sales ratio. We're taking a median and say, okay, in the next 5 years, it's very likely that the price to sales ratio of these stocks will be somewhere in the median of the last 5 years, high and low and average of the overall market and the technology sector. With me so far? Any questions? You can ask questions later on, of course, if you come, but just follow that logic with me. And then I went to the next step. I tried to see, okay, where the growth is coming from for these companies, right? We obviously have the forecasted revenue growth for the current fiscal year for these companies. So this is what they're forecasting this year. So Coinbase, for example, is forecasting a negative growth, right? So we're being fair. We're actually putting the actual forecast. I brought the year-over-year revenue growth rate of the last quarter. So whatever the revenue was last quarter compared to the previous year's the same quarter. And then I looked at the primary industry that those companies operate in, and I brought the forecast growth rate for that primary industry. So for example, for Tesla, this first row, 23% is the expected growth rate of the electric vehicle industry in the next 3 to 5 years, right? And then I use these 3 growth rates to estimate what could be the growth rate of revenue of each of these companies be in the next 3 to 5 years, right? So at minimum, they're going to grow similar to the primary industry that they operate in. Tesla being in EV, Coinbase being in digital currencies, Zoom being in basically video teleconferencing, right? Teladoc being in telehealth industry. So those are those kind of growth. So they, even if the companies are still not good companies, just followed what is happening in the industry, this could be their growth rate. Of course, we would give them some benefit of doubt in terms of the growth rate that is happening in their history, because some of them are not in the same place. And I calculated the average growth rate that we could expect from these companies. And then the last part, hopefully I'm not boring you with a lot of math, but basically what I did is that I estimated the revenue of these guys using this growth rate in the next 5 years, right? So that's basically just taking their existing current revenue, multiply that by that compounded annual growth rate that we estimated together right now. And then basically what I was able to calculate is what would be their market cap using that price to sales ratio that we calculated in step 1, right? So let me pause again. I calculated some average price to sales ratio for these companies. I came up with some sort of a growth rate for the revenue for the next 3 years. And then I used that to calculate or estimate their market cap in the next 5 years, right? Because we want to compare that market cap that we estimated. This is a range of market cap that I estimated for these companies. We wanted to figure out, using that market cap, is the compounded annual growth rate in these companies justify keep buying this stock above where they are right now? So do we sell these companies? Should Cathie sell these companies, or is it fair and that Cathie doesn't sell them and keep buying them? That's the question we're trying to answer. So the current combined market cap of these companies is here. Estimated market cap of these companies using the current price to sales ratio is about 8, and estimated market cap in 5 years using the median price to sales ratio we calculated together, it's going to be somewhere around 5. So if I calculate the compounded annual growth rate of these estimated market caps between today and 5 years, I get to an expected 53% growth rate in market cap per year in the next 5 years, or 44. So the reason Cathie is not selling, and I am giving her the benefit of doubt right now, and I believe her decision is as logical and not and sane, is because based on this valuation methodology we did, it's possible that these companies are going to grow between 44% to 53% per year compounded in the next couple of years. So we've heard her talking about 40%, 50% compounded annual growth rate. And I just did the exercise with you, and I don't believe she's crazy. I actually believe, based on very solid numbers that we just had together, there is a really, really growth potential sitting in top 5 holding of ARKK. And that means that's why Cathie is not selling. And that's why it may not be a bad thing that Cathie is actually not selling and actually keep buying, right? So let me go back to the presentation. Hopefully that was not a lot of detailed math. I'm happy to share that Google Sheet with anyone who interested. It's a public Google Sheet, so just let me know if you want to get a copy of that and you want to look at the math later on. But basically, let's wrap it up together in terms of what we decide. So we looked at the track record of handling market cycle by Cathie Wood, and we give her a pass because it's not her first rodeo, quote unquote. She's been through the same problems, ups and downs, going against the convention of the market, conventional wisdom of the market, or widespread wisdom of the market, and she survived and thrived actually through those cycles since the start of her fund. In terms of investment process, we give her a pass because as you saw, she had a solid team. She has in-depth research that she shares openly, and she invests in companies with solid track record. So it's not companies that just like came out of the thing, there's no revenue with them. She may take some small bets in the smaller companies that don't have those kind of solid track record, but the main components of her flagship fund, the top 5, and if you continue the exercise in the top 10, you're going to get the same results almost, is that she's focusing on solid companies. So we give her a pass for her investment process. We did sanity check of the decision, and I don't give her just a pass, but it really depends, because we looked at this, we did the valuation together for a 5-year period, and we saw that the forecasted growth rate for those top holdings is solid and based on some sort of a logic that you and I understand. But it depends what your investment horizon is and what you're trying to achieve, right? Nevertheless, we know she doesn't manage risk. So for someone who actually can't tolerate big downfall into her portfolio, she may not be sane. She may be insane with that point of view, just the same as how her previous boss from AllianceBernstein said, she sounds illogical and insane if your goal as a fund is to protect your investor against a downfall, right? So that's why I'm saying she could be being crazy. She could be considered crazy if the goal is to protect wealth, right, as opposed to losing it. But if your goal is long term, if your goal is to bet on the future of rapidly growing companies that have a compounded annual growth rate potential of 40 to 50 to 60% per year, then she gets a pass, right? So it depends. And that sort of concludes what I wanted to share with you. It's a framework that we just went through to evaluate a fund manager like Cathie and compare it to Garrett, the emerging growth fund from the tech bubble in 1999 and 2000. And the conclusion of the framework is that no one has a golden touch. Even Cathie, when we looked at it, we didn't give her a hard pass for her sanity of her decision-making, because nobody can have a golden touch and consistently. I think one of our participants audience just said, I think it was John or somebody else, BJ, I believe, he said, nobody can have consistent track record, right? Nobody can have golden touch. So if you hear in media that somebody says the X and so has a golden touch, whatever they do, it's going to turn into gold, that's just plain media playing games of emotions and being very vocal or being very provocative about someone So that's number one. No one has golden touch and hard to be consistent. And the other thing is we need to remember return doesn't come from consensus. So had Cathie believed in the same consensus that everybody else had, she would have sold Apple out of her fund in 2015, 16, and she would have lost on the excellent gain that Apple has had since then. And there's a lot of other examples there. So we can't just punish investors or a YouTube personality or a celebrity investor or a friend or ourselves because we are agreeing with what media says or what is happening, what is the agreement in the market, right? So those are my three conclusions from that framework. I have to say I am an investor in Cathie Wood and her fund. I did not invest until she hit the 60% drop. And since then, I started investing recurring $1,000 every week. So I wanted to make that disclosure that the reason I'm investing is in her is because of this framework that I just showed you. So wanted to be too transparent with you. Hopefully I'm right, and hopefully the framework makes sense. Happy to take any questions. Other than that, as I said, founder of Stockyard.io, and would love to have you there. There's a lot of free tools to use on Stockyard.io, so hopefully we'll see you in the community too. And I take a little bit of question. I guess we have about 10 minutes or 9 minutes. If there's any question, I'll take it. Otherwise, I'll give back some rest time to you.
Right before you came on, I was talking about podcasts, and I know you have one. So if you want to talk about your podcast a little bit.
Sure. Yeah. So we have a YouTube channel / podcast, and the podcast is called Renegade Investor. And the goal was from day one to interview renegade investors, people who go against the conventional wisdom of the market. And we spend a lot of time inviting Twitter personalities and YouTubers or fund managers that we believe they are renegades, and they actually focusing on investing away from consensus. So that's the podcast show. It's a weekly thing that goes on Sunday mornings, goes live on Sunday morning. You could get it on YouTube as well. So whenever we have a conversation, we just record it like this, and we have it on the YouTube show. Our YouTube is the Stockyard YouTube. So if you search Stockyard, you can find our YouTube show. It's relatively new, and our podcast is Renegade Investors. I guess, David, I don't know what would be a good way to share, I guess, the presentation, share the links to the podcast and things like that. I'll follow. Thank you. Yes, that's our Stockyard.io, that's our company. Actually, I'm going to show you, since the link is here, if you want to listen to our podcast, or if you want to listen to our YouTube, watch our YouTube, if you go to Stockyard.io and scroll down to this footer section, so you'll get our blog, you get our podcast, you get our Facebook group and our YouTube channel. So that would be the best way to find us. Excellent. Well, David, it's been a pleasure. Thank you so much for having me here and inviting me to this conference. And hopefully I can come back soon and share more with your community.
Yes, definitely. Great presentation. Thanks for being here.
Thanks, everybody. Enjoy the rest of the conference.